Do you own a holiday let property investment? Do you want to know what the allowable costs are and indeed how you can claim capital allowances? Then you better watch this video. So as the intro suggested, we are now going to look at holiday lets and what the allowable costs are to offset against your rental income, or holiday let income I should say, and we will also be looking at capital allowances as well and what the tax benefits are for each one. So let's go ahead now and look at the detailed slide. So here we're talking about now holiday lets and service accommodation allowable costs and indeed the capital allowances. And one thing I would say to you is we have produced already videos on allowable costs for single let property investments and HMOs. And you might want to watch this video, so it should be appearing above my head right now. So make sure that you click on that to watch that video if you have single let properties or HMOs. We are going to be focusing purely about holiday lets and service accommodation at this point in time. Remember guys, if you do have any questions about what I'm talking about, then make sure you drop your question below the comments box, below this video, and I will get back to you as soon as I can. So let's look at the criteria for holiday lets. I think it's always worth looking at this. The property must be available for 210 days. That's 210 days. So you must have a holiday let that's available for then. It must be also let for 105 days out of that 210 days that it's available. It must not exceed 31 days for the average let. Now there are certain circumstances that it can be breaching that number, but honestly, keep it simple. Do not go above those days. And it must be commercially let and furnished. So as long as you keep to this criteria, your property will be considered to be a holiday let. Now a couple of other things that is not HMRC related is the dealings with your mortgage. You have to have the right mortgage product. You can't simply have a standard buy-to-let mortgage on a holiday let. You should be using a commercial finance product. So make sure you speak to your mortgage broker about that in more detail. You also need to change the use class of your property. Why? Well, because you need to. So it's not a standard buy-to-let. You don't have residential. You have guests staying at your property. So the use class of your property also needs to be changed, and therefore you will have commercial rates for your property. People using holiday lets will benefit from Section 24 mortgage interest relief because it does not affect them. So mortgage interest costs will be allowed to be offset against your property income for your holiday lets. So let's go through the allowable costs for your holiday let and service accommodation. Now, in the previous video I talked about this, but it's pretty much the same story here. You could have repair, replace, renew. So imagine that you have bought an apartment in London that you're going to be using as a guest house. Now, you could be repairing the cabinetry in the kitchen. That cost will be 100% allowed to be offset against your property income. You may also be replacing the bathroom suite because, let's be fair, it's not nice. You get better income per evening if it was in better condition. You might renew the paintwork and the plastering as well, which means that all of these costs I've talked about so far are 100% allowable to be offset against your rental income. Things like changing single glazed windows to double glazed windows may be seen by other accountants as an upgrade. Well, that's not the case. It is a replacement. All a window is doing is stopping the rain and the wind from getting into your property and keeping your guests warm and dry. So from HMRC's perspective, they understand this, so the cost would be allowed if you replaced your windows. Fuse boxes, boilers, you name it, they are all replacements, even though technology has moved ahead. So please do not be fooled by your accountant that sees this as a capital expense, which then you cannot offset against your property income. Make sure you challenge your accountants to get the right cost offset. Now, I always say that you need to consider the phrase like for like. Like for like is from HMRC legislation manual. So if you are carrying out any repairs, renewals, and it's for like purposes, then the cost will be offset. And you can see here we've got a 1970s kitchen over here on the right, on the left I should say, depending which way you're looking at it actually, but you will see the 1970s kitchen and you're going to be upgrading that to a nicer kitchen. Now, some accountants might say, well, that's a total upgrade, look at how brilliant it looks. Well, in reality, you're not really doing anything different. You've still got the same size cabinetry at the end of the day. The room size hasn't changed. You might just making it look better. What are you doing? You're increasing the amount of rent, or guest fee income, I should say, per night. So this is a revenue expenditure. So make sure you work with your accountant. This wouldn't be allowed. It's where you're taking the 1970s said kitchen and then upgrading it. And you might be extending the property. You might be creating new bathrooms, new bedrooms, which weren't in existence before. The kitchen itself in this description has got underfloor heating. It's not through one of the dining rooms. It's doing an amazing job to make it look fantastic. Well, unfortunately, HMRC will not see this as a like-for-like replacement. And indeed, what they will do is say that these costs are capital in nature. These costs will then be put onto your balance sheet and you can reduce your capital gains tax charge when you sell the property. But you cannot offset these costs against your rental income, sadly. So here's what I've got for you. This is not claiming refurb costs and claiming refurb costs. So you'll see the rental income from guests is £100,000. The services rendered, so that could be your cleaning, it could be staff that you have for your holiday let service accommodation, so £30,000 on each. You'll see that you may not be claiming it because your accountant's not really viewed these as like-for-like replacements and put them in on your capital balance sheet. Incorrectly, by the way. So we're going to look at if you allocated these costs correctly using the like-for-like replacement, repair, renewals concept, and £50,000 of that is your refurb. And basically it will reduce your profits from £70,000 to £20,000. And what I've done for you, by the way, is assumed a 17% corporation tax rate. Why am I looking at corporation tax rather than income tax? Well, to be fair, I think that most people will be using limited companies as a professional landlord going on from the year 2020 anyway, which we're in for now. So ultimately, that's why I've used a 17% corporation tax rate, which is coming into effect from April 2020. So you'll see the reduction of the corporation tax charge as a result of using these like-for-like repair, replace, renew concept costs. Ultimately, guys, you've got to work with a good accountant to help you reduce your tax liability. If they are not reducing tax liability in this way, then please, please, please do yourself a favor. Pay more, but get the right person on your side. If you do have any questions about the allowable cost, then make sure you write your questions below the comments box beneath this video, and I will get back to you typically within 48 hours. Not too bad, is it? So I will make sure I get those answers to you as soon as possible. But now we need to turn our attention to capital allowances. What are they? Well, capital allowances, as you can see in the description, we'll be looking at things like your furniture, your integral features of your property. You've got your furniture there, you've got your fuse box, you've got your lighting systems, you've got heating systems, etc. These are the things that you may be able to claim yourself under the capital allowances scheme. But I would work with a company like Six Forward, so Six Forward, who will be able to provide you with a capital allowance report. Why would you work with a company like that as opposed to doing it yourself? Well, as you can see on this description, I can see the kitchen, but I might not be able to value the pipework behind that kitchen. So this is what we've got. This is all the things that are hidden beneath the walls. So these are the kind of items that a company like Six Forward can indeed value on your behalf. And they'll be able to put this then on a capital allowance report and help you reduce your corporation tax liability. And indeed, if you're investing in your own name, it can help you to reduce your personal income tax band as well. But again, I'm focusing purely on corporation. So as I have said already, that the company like Six Forward will be able to look behind the walls of your property and identify additional costs that you can offset against your property income. And what I'm talking about here is this furniture, hidden pipes, wiring and water systems, which they may be able to generate a report that produces a £30,000 cost, additional cost, that you can then offset against your income. So we're increasing the cost base from £50,000, which you could claim yourself, as opposed to £80,000, which the report from Six Forward may be able to produce for you. Well, what does that really matter? Well, hopefully, before we go into the detail of that, if you want to know more about capital allowances, by the way, do go to HMRC's website. I've given you the link of that there. Make sure you do read upon this. It's really important you get the right knowledge behind yourself. I appreciate that your accountant can tell you all of this, but sometimes, just sometimes, being knowledgeable yourself, not too knowledgeable, but being aware of things may help you save a lot of tax. So make sure you do that. And I've also given you the kind of rates and how things are deemed to be a capital allowance claim from a HMRC perspective. And again, the link is provided here for you. We've also got the rates. Now, the annual investment allowance. So let's imagine that the capital allowance report, as we said earlier, they identify a cost of £80,000. Well, you'll be pleased to know that there's something called an annual investment allowance, so AIA, annual investment allowance. And it basically means that you can claim up to £1 million worth of annual investment allowance against your income. So in the previous slides, I talked about a capital allowances cost base of £80,000, which basically means that you can reduce that against your property income. We're going to see that a little bit later. But even if you can't get the annual investment allowance claim, you can get different rates. So the rates that capital allowances can be claimed, if you're not going to be claiming them in the year that you purchase the property and refurb the property, which is annual investment allowance criteria, you can still claim capital allowances, but at a reduced rate. So you're getting the benefit over a number of years. But for my money, an annual investment allowance claim is far better because you can offset the full cost of that development work against your income, provided that you work with a tax-savvy accountant and indeed the capital allowances company called Six Forward. And again, the URL for the pool charges are there. So what I'm describing to you now is the fact that you might have this position here whereby you've got £100,000 services rendered and you've got £70,000. But because you claim these capital allowances, now you've got £80,000 of capital allowances to be claimed. You've made a £10,000 loss, which then can be offset against your future profits. Now, the nice thing about this is on your financial statements for mortgage purposes, and this is really interesting, for mortgage purposes, they will see that you've made a profit of £70,000. But in geek awareness, this is a CT61 tax report, which would then show a loss of £10,000. So you're getting the benefit of showing mortgage companies that you are very profitable, as opposed to offsetting your costs against your income, as we might have done on the repair, replace, renew concept in previous slides. Here we're saying, well, we're not going to do that. We want to maximize the amount of profits we make, which means that we're more mortgageable. People might look at us in a different light if we're more profitable, but we still want the tax advantages of a capital allowances claim. And that can provide you with great benefits all round. If you do have any questions about capital allowances, again, please do feel free to drop your questions below this video. I will get back to you as soon as I humanly possibly can to get you the very, very best answers.